Hi, and welcome to our 2016 analyst presentation for Key Energy Services Incorporated. This analysis is part of the Birkenrode Reports and Equity Analysis program at Tulane University's Freeman School of Business. I'm Kathleen, and my fellow analysts are Peng, Mia, and Zita. Our investment research manager is James Skipton, and our associate director is Daniel Brownfield. The presentation will provide an overview of the company, our equity evaluation, highlight some important changes in Key's operations over the past year, impacting its potential for investment. Key Energy Services is an oilfield services company headquartered in Houston, Texas, under the ticker symbol KEG. Until mid-2015, Key operated internationally, but discontinued its operations in South America and the Middle East. The company is currently considering the sale of its Russian operations. Key has shifted its strategy by now focusing on its North American operations. Key is the largest onshore rig-based well servicing contractor, providing its clients with many oil field assistance services through Key's rig services, fluid management, coiled tubing services, and fishing and rental services. As of March 16, 2016, our analysts arrived at a 12-month target price of 70 cents. Key was trading at 45 cents with a market capitalization of $72.6 million. We found this valuation by using a price-to-cash flow multiple derived from averages of peer companies including Nabors Industry, Pioneer Energy Services, and Basic Energy Services. We could not consider earnings-based multiples because most of the oilfield services companies had negative earnings the past year due to the low oil prices, and the other multiples were unreasonable because of decreased sales. Because of the poor state of the oil and gas industry, Key has taken action to shift its company's strategy to remain profitable. Key has been very aggressive about cutting any unprofitable aspects of its operations, like the international segment, and unnecessary costs over the past year to be more efficient. Key was able to generate a large and positive cash flow by selling off its international segments, which is very important for the company over the next year as prices are still very low and production is weak. Key refinanced its debt, including paying off its old debt in 2015 and securing a new credit facility to improve the company's liquidity. Key is still at risk of default because of its large amount of debt and lagging revenues, so the company must continue its current strategies to remain efficient. In the past year, oil prices hit a high of $52.98 per barrel on August 31st, 2015, and a low of $26.61 on February 11, 2016. Because of oversupply and high pressure to compete, E&P companies needed to cut production and spending. Like all oil and gas companies, Key hopes for higher oil prices, or at least for a more positive outlook, because the company is highly reliant on its customers increasing capital expenditure and resuming production. Because of the poor market, Key decided to only pursue markets that are the most economically profitable, leading to the company's international exit, as the international segment only contributed about 5% to Key's total revenue in the third quarter of 2015. Most of the assets were impaired, sold at a loss, or transported back to the U.S. for storage. These devaluations of assets and operating losses hurt Key's revenues in 2015, but also helped generate some cash flow, which will help the company over the next year when oil prices are still very low. The company's shifted strategy is more comprehensive than only focusing on North American operations. Key also took extreme cost-cutting measures over the past year and into the first quarter of 2016, while also pursuing new streams of revenue while production is idle. Key plans to limit capital expenditures to $40 million or less in 2016, compared to capital expenditures of around $60 million in 2015. Key mainly reduced costs through widespread layoffs. The company cut its workforce in half in the first 3 quarters of 2015 and has continued to reduce headcount, wages, and facilities. Wages are a huge portion of Key's variable production costs, making wages the most necessary expense to cut in order to offset the company's high fixed costs. These headcount reductions allowed Key to streamline its operations by consolidating many of its business teams, cutting direct operating expenses by 32% from the third quarter of 2014 to the third quarter of 2015. Key will also enhance its business units that focus on extending the life and recovery of a well to offset the effects of oil price volatility, which impacts drilling and completion services. Key also wants to focus more on horizontal well services since so many have come online in recent years and would expand Key's revenues. In the second quarter of 2015, Key replaced its $400 million revolving credit facility due in March of 2016 with the $100 million ABL credit facility and a $315 million term loan. This refinancing provided Key with an inflow of cash, allowing the company to replenish its low working capital and improve liquidity. Key also took on additional pressure to pay variable interest rate payments on the new debt due to the high financing costs in the currently sluggish market. If Key fails to make its interest payments, the new credit facility will require Key to pay off the debt at an accelerated rate, which could push the company to default. It is likely that the company will need to refinance its debt again before it expires in 2021, and Key will need to stay within its covenants in the coming years in order to have this ability. Key will need to be careful of its current financial position until oil prices improve and its liquidity risk lessens. Key had a debt-to-equity ratio of 6.88 in 2015, which is significantly higher than historical averages and raises concern. However, the company has operated with a high level of debt over the past few years because it is so susceptible to oil price volatility, which provides hope that Key will continue to operate and survive in the unfavorable market climate. Key's future has great potential. Robert Drummond joined the company in the third quarter of 2015 and took over the role of CEO in the first quarter of 2016. Additionally, the EIA predicts the West Texas Intermediate prices will rise to $50 per barrel in the middle of 2017, which would be a healthy price for both Key and the industry as a whole. With improved prices and new strategies, Key can recover. Key's stock has been trading at all-time lows over the past year and received a delisting notice from the New York Stock Exchange because Key's stock remained below $1 over a consecutive 30-day trading period. If the stock price remains low in 2016, the company's board will vote on a 10-for-1 reverse stock split in November to avoid this delisting. We predict a moderate improvement in the stock price once oil prices improve in the second half of the next year. We also think the company has done well cutting its costs and improving its liquidity, which will improve the company's earnings. Thank you for listening to our presentation on Key Energy.